Bitcoin moved 9% in a single month. It also ended that month up barely 1.5%. If Bitcoin is supposed to be a hedge against inflation, is that what a hedge looks like? Let's start with the promise, because it's a good story. Governments print money. Money loses value over time. You need somewhere to park your savings that doesn't erode with it. Gold has done that job for centuries. Bitcoin, the story goes, is digital gold. Fixed supply. No central bank. No printing press. Just 21 million coins forever. So when inflation eats your paycheck, Bitcoin is supposed to sit there quietly, protecting your purchasing power while the dollar melts around it. That's the theory. Now look at what actually happened over one recent month, because the behavior tells a different story than the pitch. Bitcoin opened that month at $63,547. It closed at $64,488. Net change, plus 1.48%. Modest gain. Nothing dramatic. If you only looked at the start and end price, you'd shrug and move on. But that hides the real story. During the same month, Bitcoin dropped as low as $61,275 and spiked as high as $66,910. That's a swing of nearly $5,700 from bottom to top, roughly a 9% range, peak to trough, inside a single month. 9% of chaos to produce 1.5% of net result. Sit with that gap. A 1.5% gain is the kind of number a decent savings account might produce in a high-rate environment. And it gets there the boring way, slowly, predictably, no drama. Bitcoin landed near the same result, but it took a roller coaster to get there. Up, down, up again, just to end close to where it started. Here's the important part. What does a real inflation hedge actually look like mechanically? Think about gold. Think about Treasury inflation-protected securities, bonds literally built to move with the cost of living. Those assets are boring by design. Their job is to not surprise you, to track inflation steadily, so when you convert them back to spending power, the value is reliably there. A hedge that's down 10% the week you need it isn't doing the job of a hedge, no matter what it does over the following year. Bitcoin's price action in this window looks nothing like that. It looks like a risk asset, a high beta tech stock, something that trades on sentiment, leverage, liquidity, whatever headline crossed the wire that morning. Assets like that can still make you money, sometimes a lot of it, over the long run. But that's a different job than hedge. A hedge is about certainty, exactly when you need it. A risk asset is upside with volatility attached, and you don't get to choose when the volatility shows up. So here's the practical takeaway. This doesn't prove Bitcoin is a bad investment, and it doesn't prove the long-term returns aren't real, because they've been strong over Bitcoin's history. 1 month of data can't settle a debate that needs years of data against actual inflation numbers we don't have in front of us here. What this 1 month does show is narrower but useful. What Bitcoin's short-term behavior actually looks like versus what the word hedge implies. If you're holding Bitcoin because you believe in its long-term trajectory as a growth asset, that's one conversation. If you're holding it because you expect it to protect your purchasing power on a predictable timeline, the way gold or inflation-protected bonds are designed to, this kind of swing should give you pause. The label and the behavior aren't obviously the same thing. So before you park your rent money in Bitcoin because someone called it digital gold, ask yourself a simple question. Would you be comfortable if the money you need next month swung 9% before it got there? If the answer is no, you're not describing a hedge. You're describing a bet, and bets can still pay off. Just don't confuse the two, because knowing which one you're holding is the difference between a strategy and a surprise.